Today we're tackling a topic that feels complicated, but I promise by the end of this video you'll get it. We're talking about funds, specifically index funds, mutual funds, hedge funds, and ETFs. I know. It sounds like a bunch of Wall Street jargon. But what if I told you that understanding these simple concepts could be the key to unlocking your financial future? What if this is the one thing that helps you finally break free from the paycheck to paycheck cycle? Stick with me, because we're about to make it all crystal clear. So, what is a fund anyway? Let's start with the basics. Imagine you and a group of friends want to buy a giant pizza. But this isn't just any pizza. It's a super deluxe pizza with every topping imaginable. Buying it all by yourself would be expensive, right? But if you all chip in, you can easily afford it, and everyone gets a slice. An investment fund is pretty much the same idea. It's a big pool of money collected from many investors, all put together to buy a wide variety of investments, like stocks, bonds, and other assets. Instead of you having to go out and buy hundreds of different stocks one by one, the fund does it for you. You own a piece of the fund, and the fund owns all the different investments. Simple, right? It's all about collective investing power. This is a huge advantage for everyday investors. It gives you instant diversification, which is just a fancy way of saying you're not putting all your eggs in one basket. If one company in the fund doesn't do well, it's balanced out by all the others. This lowers your risk and helps you build wealth more steadily over time. Now that we know what a fund is, let's look at the different types. And this is where it gets really interesting, because they are not all created equal. First up, let's talk about mutual funds. Mutual funds are one of the most common types of funds out there. They've been around for a long time, since the 1920s in fact. The first one was the Massachusetts Investors Trust Fund, which started in 1924. Think of a mutual fund like a bus tour. You have a professional tour guide, the fund manager, who decides where the bus goes. They're actively picking the stocks and bonds they think will perform the best. They're trying to beat the market. They're looking for those hidden gems that they believe will give you the highest returns. This sounds great in theory, right? Having a pro in your corner, making all the tough decisions. But there's a catch, and it's a big one. These fund managers charge for their services, and those fees can really eat into your profits over time. We're talking about management fees, administrative costs, and sometimes even sales charges. The average actively managed mutual fund has an expense ratio of around 0.57%. That might not sound like a lot, but trust me, it adds up. And here's the thing. Most of these highly paid professionals don't even beat the market in the long run. A recent study from Morningstar found that over the 10 years ending in June 2025, only 21% of active funds managed to survive and outperform their index counterparts. And for large U.S. stocks, it's even worse. Only 14% of active managers beat the S&P 500 over the last decade. So you're paying extra for a service that, most of the time, doesn't even deliver better results. It's like paying for a premium pizza topping, but you can't even taste the difference. Mutual funds are also not very tax efficient. When the fund manager sells a stock for a profit, those capital gains are passed on to all the investors in the fund. That means you could end up with a tax bill even if you never sold any of your shares. So, who are mutual funds good for? They can be a decent option for someone who wants a completely hands-off approach and is willing to pay for the potential, however small, of outperforming the market. But for most of us, there are smarter, cheaper, and more effective ways to invest. Now let's talk about index funds. If a mutual fund is an actively managed bus tour, an index fund is more like a self-driving car that's programmed to follow a specific route. It's not trying to find secret shortcuts or scenic detours. It's simply designed to match the performance of a specific market index, like the S&P 500. The S&P 500 is just a list of the 500 largest companies in the United States. So, an S&P 500 index fund will buy shares in all 500 of those companies in the same proportions as the index itself. It's a passive approach to investing. The fund manager isn't making any active decisions. They're just following the index. And this is where the magic happens. Because there's no team of expensive analysts and stock pickers, the fees for index funds are incredibly low. We're talking about expense ratios as low as 0.05% or even less. That's a huge difference compared to actively managed mutual funds. Let me put this into perspective for you. Let's say you invest $100,000 and earn a 4% return per year for 20 years. With a 1% fee, like you might find with an actively managed mutual fund, you'd end up with about $179,000. But with a 0.25% fee, which is more typical for an index fund, you'd have over $208,000. That's a difference of almost $30,000 just from fees alone. And remember how we said that most active managers don't even beat the market? Well, with an index fund, you're guaranteed to get the market's return. You're not trying to beat the market. You're trying to be the market. And over the long term, the market has a pretty good track record. The S&P 500, for example, has averaged a return of around 10% per year over the last 90 years. Index funds are also more tax efficient than actively managed mutual funds. Because they're not constantly buying and selling stocks, They generate fewer capital gains. This means you're less likely to get hit with an unexpected tax bill. So, who are index funds best for? Honestly, for most everyday investors, index funds are one of the smartest choices you can make. They're low cost, they're diversified, and they have a proven track record of long-term performance. Think about it this way. If you had invested $10,000 in an S&P 500 index fund 20 years ago and just left it alone, you'd have over $60,000 today. That's the power of long-term, low-cost investing. You didn't need to be a stock-picking genius. You didn't need to watch the market every day. You just needed patience and discipline. If you're looking for a simple, effective way to build wealth over time, index funds are a fantastic option. Next up, we have ETFs, or exchange-traded funds. ETFs are a bit of a hybrid. They have some things in common with mutual funds and some things in common with stocks. Like an index fund, most ETFs are passively managed and track a specific index. So you get the same benefits of low costs and diversification, but here's the key difference. ETFs trade on a stock exchange, just like individual stocks. This means you can buy and sell them throughout the day, at whatever price they're currently trading at. Mutual funds, on the other hand, are only priced once a day after the market closes. So if you place an order to buy or sell a mutual fund, you won't know the exact price you're getting until the end of the day. For most long-term investors, this isn't a huge deal. Whether you buy at noon or at 4 p.m. probably won't make a big difference to your returns in 20 years. But for more active traders, the ability to trade ETFs throughout the day is a big advantage. ETFs also have another advantage when it comes to taxes. They are generally even more tax efficient than index funds. The way they are structured means that they can avoid passing on capital gains to investors in the same way that mutual funds do. And what about minimum investments? With ETFs, you can often get started with just the price of a single share. Some brokers even let you buy fractional shares so you can start with just a few dollars. This makes ETFs incredibly accessible for new investors. So, who are ETFs best for? Like index funds, ETFs are a fantastic choice for most everyday investors. They offer the same low costs and diversification with the added benefits of being more tax efficient and easier to trade. Let me give you a real example. The Vanguard S&P 500 ETF has an expense ratio of just 0.03%. That means for every $10,000 you invest, you're only paying $3 per year in fees. Compare that to an actively managed fund charging 1%, where you'd be paying $100 per year. Over decades, that difference becomes life-changing money. If you're just starting out, or if you want a simple, low-cost way to invest for the long term, ETFs are an excellent option. Finally, let's talk about hedge funds. Hedge funds are the most exclusive and mysterious of the bunch. They're like the secret off-menu item at a fancy restaurant. They're not available to the general public. To invest in a hedge fund, you need to be an accredited investor. This means you have to have a net worth of at least $1 million, not including your primary residence, or an annual income of over $200,000 for the last 2 years. So, right off the bat, hedge funds are not for most of us. Hedge funds are also much less regulated than mutual funds and ETFs. This gives them a lot more freedom to use aggressive and complex investment strategies. They can use leverage, which is borrowed money, to amplify their returns. They can short stocks, which is betting that a stock's price will go down. They can invest in all sorts of exotic assets, like derivatives and currencies. Because of these high-risk strategies, hedge funds have the potential to generate very high returns. But they also have the potential for huge losses. It's a high-risk, high-reward game. And the fees for hedge funds are in a whole different league. They typically charge a 2 and 20 fee structure. This means they charge a 2% management fee on all the assets they manage, plus a 20% performance fee on any profits they make. So, if the fund does well, the managers get a huge payday. Hedge funds are also very illiquid. This means it can be difficult to get your money out. They often have lockup periods where you can't withdraw your money for a year or even longer. And even after the lockup period, you might only be able to withdraw your money once a quarter or once a year. So, who are hedge funds for? They're for wealthy, sophisticated investors who are willing to take on a lot of risk in the hopes of getting very high returns. They are not for the average person who is trying to save for retirement or build long-term wealth. So, let's bring it all together. We've covered a lot of ground, so let's do a quick recap. We have 4 main types of funds: mutual funds, index funds, ETFs, and hedge funds. Mutual funds are actively managed, which means a professional is picking the investments. This sounds good, but they have higher fees and most of them don't even beat the market in the long run. Index funds are passively managed. They simply track a market index like the S&P 500. They have very low fees and a great long-term track record. ETFs are similar to index funds, but they trade like stocks on an exchange. They are also very low cost and tax efficient. And hedge funds are for the super wealthy. They use high-risk strategies and charge very high fees. So what's the bottom line for you, the everyday investor? For most of us, the smartest choices are index funds and ETFs. They are the most accessible, the most affordable, and the most effective way to build wealth over the long term. They take the guesswork out of investing. You don't have to worry about picking the right stocks or timing the market. You just invest consistently, keep your costs low, and let the power of the market do the work for you. I hope this video helped you understand the world of investment funds a little better. If you found it helpful, please give it a thumbs up and subscribe to the channel for more videos like this. And if you have any questions, leave them in the comments below. Thanks for watching, and I'll see you in the next video.